Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Jamie Hopkins, director of retirement research at the Carson Group, to discuss Social Security and lifetime income in a low-yield environment. Jamie, it's great to see you again. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me on again.
You got it. And my question to you is, are we at a crisis point when it comes to flows for retirement? And were any lessons learned from the pandemic?
Yeah, I think there's a couple lessons we learned, and I'm not sure they're always necessarily good ones in the pandemic. We saw a couple things that I think big picture and some things I'm concerned about. One of them being the funding status of Social Security. I'm really worried about that report when it comes out this summer. So I think we could lose multiple years of funding from Social Security, and that's just going to be everywhere. The downside of that is, how do people react to that, right? Do they react in negative ways in the market? Do they chase risk? Do they lose faith in the Social Security system? So that's a big one. Obviously, the long-term care industry got hit really hard. I mean, nursing homes, we lost lives, and it's been really disruptive. And that's a big part of retirement planning, is where do we save? Where do we go for care long term? And I think there's going to be a shift in behavior there in the way that we fund for retirement and have those conversations about, do I want to end up in a nursing home? That's a really big shift we're going to see here after 2020.
And it sounds like you think Social Security is going to take a hit here. So realistically, how much longer can the trust be funded?
Yeah, so if you look at some of the projections that kind of took 2008, 2009 into account, some of those same projections say we might lose about 4 years of funding on that trust report, because so many people were out of the workforce, not paying their FICA and SECA taxes into Social Security. So we might go from like a 2035 funding down to maybe 2031. If that happens, I think it puts a lot of pressure on Congress to act, because now we're within a decade of this, kind of completely breaking. So that's a really big challenge. It does relate to, what President Biden ran on about fixing Social Security, but it would put some more pressure on that moving forward.
When you think of it in those terms, it is less than a decade away. 2030 sounds far away, but it really isn't. So what would you like to see in the Biden tax plan regarding retirement and Social Security funding?
Yeah, the Biden tax plan, actually, he has a bunch of really interesting pieces, at least that ran on, right? So I always put that out there, right? I don't know if that'll make it into an actual bill. We're just seeing the COVID bill. I think I saw a news thing pass up, is done moving forward. But what's next? So are we going to get some, changes in how we fund Social Security? That was the single biggest, arguably, provision of Biden's tax plan that he ran on, was refunding Social Security by adding that tax back on to higher income earners. It's a way to fund the system, but do people feel happy about that? They feel bought into Social Security if we're really shifting that burden to one group. The other one is did have some interesting proposals about long-term care tax credits for caregivers. AARP has supported a similar policy, so you could see some traction to that one. And then third, there were some changes on how we would do 401ks, moving away from a salary reduction system to more of a credit-based system. It's an interesting proposal. I think you'd get some pushback from the industry there, not necessarily a bad thing, but would be a really interesting proposal.
And Jamie, I want to wrap up with consumer behavior here. You noticed that annuity sales fell in 2020. Two questions. What is that attributed to? And do you think people are still using annuities as investments first and not income?
Yeah, so a really interesting thing. We just saw the annuity data come out in the last week or so. Total annuities fell about 9%. There's a couple reasons for that. One is distribution. A lot of annuities are still distributed and sold by people going out and meeting with people. When you can't go meet with people, you can't sell. So fourth quarter, we saw a bump back, but we saw a move to what we would call RILAs, registered index linked annuities, and fixed rate deferred annuities. Both of those actually had increases in sales. So while the total annuity market went down, we did see some consumer behavior to say, you know what, where I will go buy more annuity income is more of this idea of kind of offsetting maybe my bond or CDs, right? In this low rate environment, where can I go look at something else that's more secure rather than our variable products, which historically have been kind of sold to mimic market returns, right? They're securities. So that is a shift that's occurring. It wasn't a big enough shift in 2020 to overcome the total annuity sales, but there were increases in certain products, which is an interesting behavior change.
And Jamie, actually, I'm going to throw one more question at you. If we enter this rising rate environment, would that impact annuities at all?
Yeah, so arguably annuities still do better in a rising rate environment. Interest rates impact insurance companies tremendously. It impacts the payouts that annuities can deliver. I'd say academics are mixed on that. Lifetime annuities, which we're not talking about here, they perform okay even in low rate environments because it's the mortality credits that are providing some of your payout rate. But insurance products in general will do better if rates go up. So that's kind of the simple answer to that.
All right, Jamie, we appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.